Hello.
This
Today's
is another
video
presentation
on
on
Chapter 8,
Risk and Return.
We're using the PowerPoint video presentation as starting from the PowerPoint slides to talk about beta. Beta is part of the discussion on risk and return. Beta is a fundamental concept to a good bit of finance. Chapter 8 is on risk and return. We've already talked a little bit about beta, so we spent some time doing calculations regarding security market relation, overall variety of calculations in this chapter. We'll give it a beta as a result of that. By email or on the beta applies to a portfolio to a specific stock. This is a market, and it's a numerical measure of a risk. These are the 5 securities in this chapter. So the stock market beta is required returns. So we have a tendency to use this as our benchmark whenever we talk about beta or the stock market. If you have a high risk stock, generally it's going to have a beta that's greater than that. So the higher the risk, if you have a low risk stock, generally it's going to have a beta mathematical equation in this case. So this is our benchmark calculation. When we talk about stocks and risk relative to the market, the market should include all investable assets. However, in practice, we generally use the S&P 500 as the benchmark for the market if the expected return is too high. So the opening slide defines beta as measures the stock market's risk, shows the stock's volatility relative to the stock market is. Secondly, it indicates how risky a stock is if the stock is held in a well-diversified portfolio. Should go down. So beta measures the stock market risk. It does not measure idiosyncratic risk or a diversifiable risk. We assume investors will not earn return for any idiosyncratic risk. If we diversify risk away as they sell its ability to do so, intelligent investors, as the risk goes down, we assume will not have diversifiable risk. And then the third investment is the expected return is equal to the required beta of 0, no risk. All right, let's look at this. Okay, comments on beta. So these just give us a few benchmarks here, right? So a beta of 1, it's the same as the average stock, the same as the S. So here's the SML. A beta greater than 1, security is riskier than average. So for example, I think the text uses a high-tech company as representing a higher risk market. Additionally, maybe you'll talk about a biotech company as high risk, or maybe deep-sea oil drilling as a high risk. What is the expected? So those are suggested companies or securities that have a beta greater than 1. The third point is a beta less than expected return. Standard examples of lower risk companies would see utility tech or utility stock or consumer goods stock. Most stocks have betas that range between 0.5 and the SML curve represents an efficiently priced security. Okay, for collections, as we can the beta of a security be negative? Yes, it's possible, although, right, turn to the second point, or the first point, if the correlation between the stock I and the market is negative, right, then the beta can be negative. You'll notice here that if the coefficient is negative, then the beta is negative. This is highly unlikely. Most stocks have a positive beta. So, for example, we talk about gold. This is a treasury bill as a stock company that mines gold or stores gold as a commodity. In both cases, they will have a low or a negative beta, depending on exactly how their returns correlate to the market. Go to the next slide. That's why we saw a run up in gold prices during the recession. We won't spend too much cyclical. People are just a few examples that set up the market's return is going to be low questions. This is a portfolio beta. So average uses collection security betas to calculate stock portfolio beta. In this example, we're going to add 50% in high tech should 50% increase 5% of the time. Standard high tech beta is 1.32. Calculating beta is actually a negative component. So we're going to the beta look at a well-diversified investor primarily concerned with how a stock is expected to move relative to the future divided by the market in the future. No one has a crystal ball, so we have a tendency to use historical data. That low beta. In the next slide, we're going to estimate beta by running a regression. When we put it in the SML, visually it's very clear. Mathematically, it's not quite so easy, but I think you should follow the algebra, and we get a return on the slope of the regression line defined as the beta for the security. Another way to get that 25% of the time. So here's our average. This calculates the beta. Here's our regression line. Here's the slope case, the required return 1.44. So in this example, that's our beta. 1.44 is the slope of this red line. The slope of the red line is the beta. Notice on the horizontal axis, we have the return of the market. On the vertical axis, we have the return on stock I. Okay, so we're comparing how does the return on stock I vary in comparison to the stock market. Slides on this. Let's look at year 1, positive 15 and 18. That's this point right here. Does the SML ever change? It's almost on the line, but not exactly. Questions over this, right? Then it's based on a risk-free rate of 85 and negative 10. Market risk premium. So year 2 is captured with this. What happens if the inflation shifts or goes up by 3%? So you can see this red line should basically go through the middle of all those points. I'm not sure who did this market. They probably be a little bit unfair, but that's okay. Visually, we still understand that this line is a good estimate of the line that goes through those 3 points. You can see that since this point is higher, again, this one is lower. This red line should have be required a little bit on the top and a little up on the bottom, and we would have gotten a better line. Right, for any given level of risk, 1.44 is what it says is the beta of this line, and this is one strategy for computing beta efficiently priced to compensate the investor for risk. So if the inflation expectations, this slide gives us 3 illustrations of beta, inflationary expectations. You'll notice the start at the top. This is a high-risk company. It's a high-risk, high-tech, and the beta for this is 1.32. Go down, kind of a steep upward sloping line. And the beta on Treasury bills here is 0. Treasury bills are assumed to be no risk shift, and they have no correlation to stock market returns. Went up by this. Then we have the collections company. As I suggested, this is our countercyclical security, and in this case we have a beta. So in this case, SML1 and SML2 both have a. Then one final slide we'll look at rate of 5.5. This simply looks at expected return and beta. So let's start at the bottom. We have a beta of negative 0.87. For collections, these are the 5 companies or 5 investments that this chapter follows. And you can see how the expected return and the required return increase consistently as the measured risk aversion increased. People are a little more greater the risk we bear, the greater the expected return, are worried that in an efficient market the sky is falling and there's going to be a big problem, or maybe it's prudent. Maybe the market. So that's it for this section of the PowerPoint. If you have any questions, please. And there is increasing uncertainty in the markets, and therefore we need to on the discussion site or on my email paid to those who bear extra risk. And hence, as you bear more and more risk, the required return increases. In this case, for high-risk securities, the price is going to drop a lot. For lower-risk securities, the price will drop a little. Okay. If you have any questions about any of this material, please Please email me or post a question on the discussion board. Thanks very much. Have a great day.